I rejected whole life insurance for three main reasons. Number one, it's got a very low rate of return. Number two, it is incredibly expensive to own. And number three, it is quite literally the worst investment you could ever make. Now, I was completely wrong, and so was everyone else who was telling me that over a decade ago. I'm Kyle, and I help people build financial systems and models around banking, tough money, and generational wealth. And in this video, I want to cover some of the fundamental education I had to go through to understand that all the biggest misconceptions I had heard about whole life insurance were completely wrong. And I had to completely rethink my thinking and my paradigm around money and this asset. So I want to walk you through one of the most important questions I was ever asked. We call this question 4 of 5 questions in our Factum 5. And question 4 is, do you know if the current environment where you hold your money is maximizing the benefits you deserve? Now, most of the time when we hear that question, fundamentally we know quickly a checking account and a savings account is probably not the most efficient place to store our wealth. We're not getting that many benefits from where we typically hold money in these liquid, safe environments. And this question is very important, and also having the right framework of where does life insurance even exist in my financial plan? And most people miss this, myself included, because I always thought of it as an investment, not a place to maximize benefits from where I hold cash reserves. Now, let's break this down. This is a framework we call the path of money. This is inspired by billionaire Gary Keller, and this is our rendition of this. Now, when money flows into your life in the form of income, there's really 4 things we can do with it. You can spend it, you can donate it, the rest is called savings. That's the 3rd thing we can do with it, is hold it, with the 4th thing being invest it. Now, life insurance exists right there in the hold category. It has more characteristics in common with a liquid, safe environment, like a checking account, a savings account, a CD, a treasury. It is not a checking or savings account, but it has similar benefits and characteristics. Would never, ever call life insurance an investment, and that's where the bulk of the confusion arrives around this asset, is we can't classify it properly and position it properly in our wealth plan, so it ends up being this asset we don't understand. And most insurance agents that are selling this, they don't even understand it either. So I want to break down just my experience of owning this asset for over 10 years and understanding where it exists in my wealth plan. So let's break this down. Here's an insurance contract I've had well over 10 years, coming into the 13th year. And when I pay $8,000 a year in premium, okay, that's money that I have saved. I call that savings. Premium and savings to me are the exact same word in the life insurance world. So I'm going to save $8,000 into this policy. It's going to grow by $13,000 in that very year with no risk. This is what's called a non-correlated asset. It's not correlated to the stock market. It is very liquid. It is very safe. And the growth that year comes out to $1.63 for every dollar I put into this asset that literally has no risk. Now, that is an extremely efficient place to save money. And the best part is, if I go like another 15 years out to year 28, statistically I'm likely to live that long, I'm going to pay in or save the same $8,000 in premium. That policy is going to grow by $24,000. By the way, there's no taxes on that growth, which is $3.10 for every dollar I put into this thing. Whole life, you want to look at it more like a business than as an investment. Everyone's always trying to say, oh, how early can I stop funding this? Or what's the least I can put in? If you change your thought process and say, this is nothing more than a very liquid, safe contract, I want to treat this like a business. It's going to have a cost to it in the early years, but this business is guaranteed to produce positive cash flow. I'm going to show you that with a truth concept calculator in just a minute. And so if you look at it that way, this is nothing more than a guaranteed business I'm buying that is guaranteed to produce more cash flow than what my expenses are to run the business every single year, and without working any harder or creating any more noise in my life. Now, if I go out another 15 years to like year 43, and I can reduce this thing down to the minimum premium. So I'm typically comfortable and scheduled to pay $8,000 per year. That's a combination of the base premium and a paid up additions rider. You definitely want paid up additions rider on all your policies. If I reduce this down just to the base premium, which is $2,600, If I pay in that $26.56, the policy in that 43rd year will grow $36,000 with no taxes, or $13.50 for every dollar I put into it. This is an asset that I am trying to fund and overfund every single year that I'm alive. Now, if we break this down, let's go look at those big myths that I was believing that I just wasn't educated on, so I couldn't answer or articulate this. People say these policies have a low rate of return. Compared to what? If you're comparing it to an investment, you might say yes, but it's not an investment. That's like saying I invest in a savings account. That sentence doesn't make any sense. And you'd say my savings account is not as good as my real estate property. They serve completely different functions. Liquid safe wealth is meant to protect you and set you up for opportunity. Investments are meant to accelerate wealth. There's a very common blend here, and you need both of those things working together. So when people say it's got a low rate of return, I was one of them. The long-term internal rate of return for a policy, if you keep it 30, 40, 50 years, is going to be about 3 to 4% net. Now, I'm going to help diagnose that in just a minute. This particular policy I'm showing on the screen is one of my oldest ones. It's the one we were just looking at. That policy grows $500 every single month net. And every year I keep overfunding it, it increases how much monthly growth is happening. Now, insurance. I thought it was very expensive to own. I should just buy term, do not buy whole life, it's expensive. Now I do carry term as well, and I will pay those term premiums, which are a pure expense because I don't build any equity in the policy. That's what cash value is, it's equity. So term is a pure expense. With my whole life though, I've put about $98,000 of premiums into that policy. I've got about $103,000 of available cash value, that would be the equity. So I've over 100% of the premiums I've paid are available to use for whatever I want in my life. I could invest with it, that could be my liquidity buffer. That's future retirement income I could take. I could use that to take a vacation with my family. And I have $730,000 of death benefit. So I have recouped 100% of my cost in this insurance policy, and I still have the insurance, which was one of the main reasons I was buying it. This is quite literally the cheapest insurance I will ever own in my life because every year after this now, it only gets more efficient and my equity buildup is increasing on a daily, monthly, annual basis. Worst investment of all time. It is not an investment. You cannot look at insurance as an investment. By the way, the minimum premium is $220 a month on this policy. Most Americans could start with a policy this size. This is where I started, and we've built a substantial system going forward that has ensured generational wealth. I own a large portion of the banking function in my life. We have really tough money habits because this policy is extremely tough as well. And so understanding just some of these components will literally change how you view this asset, where it belongs in your financial world. And it's why you got to get a copy of our Tough Money workbook. This will help you diagnose, like, where are you saving? Are you getting all the benefits that you deserve in that environment? And I want to show you now a truth concepts calculator. And so between going from becoming your own banker and our Tough Money workbook, which is a workbook designed to help you get all the right financial management habits when you're implementing concepts like infinite banking, will be vital. And if you can get the ideas of infinite banking down, the next thing that you want is a guide that can give you frameworks around how to understand this, but also calculations, because the math is so incredibly important. The details with these policies cannot be undermined. So I've got a truth concepts calculator pulled up. This is what's called a funding illustration calculator. So if you've seen insurance illustrations, there's a bunch of different columns on there, so many numbers. A lot of it you won't know what it means unless you have a good insurance agent that's guiding you through that. What I love about this calculator is how simple it makes the math. So in yellow here, we're looking at a 40-year-old female who's going to fund this policy for 40 years. So $20,000 a year in premium. That's her comfortable, affordable savings number. Now, with this particular policy I built, she can do in as little as about $6,000 per year, but she can do up to probably $22,000, $24,000. Now, you can design these policies 1,000 different ways. Just make sure you're buying and implementing a policy that was built specifically for you, your situation, what you're trying to accomplish. So the inputs I think of like a business expense, okay? You're going to fund your business with $20,000 per year. Now, that's a fixed expense. That's one of the guaranteed elements of the policy, is the premiums are guaranteed to never increase. So imagine buying a business where your expenses are guaranteed and fixed. So in the first year she puts in $20,000, she has available cash value of $13,000. So she already has 60, 70% of what she put into her business available to her, and she has a death benefit of $522,000. So not only does she have an efficient place to store cash that's going to get better every single year, but she's got a death benefit. By the way, this is completely private. You can borrow against the cash value for literally anything that you want. And so if you look at this, in year 4, she's going to put in 20, and this annual cash value increase column grows by over $20,000. So at this point, her business has a positive cash flow. And look, every year after that, it grows from 21 to 22, 24. The further you take these things out, the more efficient they become. And this is why if you talk to anyone who's owned whole life longer than like 10 years, everyone says, I wish those early premiums were bigger. Usually you're in a better situation financially 10 years out. And once you understand these things, you look back and say, we should have bought more of this. Now, it's okay. You start where you're at and you build from there. Now, if you look up here at the top, if we look at this over a 40-year time frame, what this calculation is showing us is the permanent life insurance internal rate of return is 3.74%. Most good whole life with a strong mutually owned carrier will pay you between 3 to 4% net every single year. So that is extremely competitive. Now, we're not used to hearing the word net in the financial world. Everything is gross. The stock market earns 10%. My real estate earns 9%, whatever these things are, but that's always gross. I found a savings account that pays 4.5%. That's a gross number. Net numbers are the only ones that actually matter in your life because that's real. Now, if we wanted to compare this against another liquid, safe asset, I'm going to turn on a 1% management fee. So I was at Chase Bank a number of years ago. We were privately financing a vehicle, and they had an advertisement for a CD, a certificate of deposit. It was like a 3-year CD that paid 5% interest. Now, 5% was gross. So I said, can I have some information on that? And when I looked at it, there was a 1% management fee that they took off the top to manage the account. And if I'm in a 30% tax bracket, now what this calculator is showing us up here at the top is the alternate interest rate I would need to earn on some other liquid, safe asset, not an investment, another liquid, safe environment, would be 6.87% every single year for 40 straight years, to be not better than, just equal to this life insurance contract. I'll tell you, I've been looking for the last decade plus. I have never found another liquid, safe asset that is remotely competitive to life insurance. In this case, a bank, a high-yield savings account, a treasury would have to pay you almost 7% every year for 40 years, gross, just to be equal to our net 3 to 4%. So what I would say is, if you're a bit like me, you're probably big on education. I want the truth. So always choose truth over trends, people over profit. And if you will embrace that, you'll see the same things that I was seeing. I was completely misunderstood because I was not educated about life insurance. So make sure you get the proper education before you ever buy life insurance. If you're not willing to do some education, I would not recommend buying whole life insurance. If you don't understand it, do not buy it. A little bit of front-end education will save you literally hundreds of thousands of dollars in the future.